Okay, so sounds good. Everyone can hear me? Hello? Okay, let me figure out what's going on there. Okay, it is, can barely hear, I'm talking softly. Okay, 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 so it's good? Okay, okay, good, so we should be good. Okay, good morning. Good, glad we're all set. Okay, today we've got a couple of administrative announcements, and then we're going to start on Chapter 5. So before we get there, Learning Catalytics is out there. The session ID is there. Just a word, because we've had a couple questions today. I can't troubleshoot for you right now, but I'll tell you a common situation we're running into. If you were using the 2-week free access, and that included Learning Catalytics, and then you purchased My Accounting Lab, and you only purchased My Accounting Lab the 60, you have to buy the Learning Catalytics separate. It's $12, I think. But those instructions are on Blackboard under Textbook and My Accounting Lab registration, and I'd be happy to talk with you after class via email, but that could be what's going on. Make sure you know your login information. Anyways, there's a session ID up there. There is a question out there. Well, it's going to be open for a while. We're not going to close that for a little while anyway. And what I want to do is start with what's due this week. We have Chapter 5 homework. Is not too bad. And then we have, if you're in Section 3 only, you also have a regular quiz. The Learning Catalytics today, until I tell you otherwise, Learning Catalytics is participation. I will not change it on you without telling you. So it's participation based. Okay, on Friday we have an optional session this week. Exam average, this is the highest exam average I've ever had, which is really exciting, 77.9%. If you would like to see where your score falls, there were 5 people who had 100% on the exam, so they ended up with 110 because they took it on Monday. There were some real healthy scores, but I have posted a list of scores at http://tiny.cc/firstexamfall. This is an Excel file. You can download it, and then you can look to see where you fall, see what the scores were. And this is the only place you can get this link. It's right here. Okay, so tiny.cc/firstexamfall, and that will give you an Excel file with all the scores. And again, the average was 77.9%. Okay, time to review your exam. If you want to go over your exam after each exam, the week after the exam, Haley has time, so she'll have time after the week after exam 2 as well. But this week, she has, these are drop-in only. Drop-in Tuesday, tomorrow 3:30 to 6:30, or Thursday 11 a.m. to 1 p.m. You could drop in any time. She's on the 5th floor of the College of Business in room 579, which is the Beta Upper Psi County Association office. And you can drop in and she'll go over your exam with you. And I sent this out via announcement yesterday as well. So it hasn't changed since yesterday, but there is the times, those are the times you can see your exam. Okay, questions before we get started? If you pay for it, tell him he's going to have to email me. I don't want to. Okay, so Chapter 5. We did skip Chapter 4, and let me tell you why. So what we're doing is we're working our way down the balance sheet in the next several chapters. And typically typically the balance sheet starts with cash and then goes into receivables and then into investments and then receivables and so on. And then we go into property, plant, and equipment and liabilities. And we're going to work our way through these chapters. But we're skipping chapter 4, which is cash, because cash is actually a very small topic. Chapter 4 has a lot of internal control, which I feel is really beyond the scope of our class. So what I'm going to do is I'm going to save cash, which is a little topic, and put it with a smaller chapter. There's plenty in chapter 5 to keep us busy without shoving in cash too. So we're just going to go to short-term investments and receivables. Today we're going to get through short-term investments and part of receivables, and then Wednesday we'll finish up. Chapter 5 PowerPoints, if you're in section 7 and 8, they are on Blackboard. If you're in sections 1 and 2, the PowerPoints will be up right after class. Okay, so short-term investments and receivables. Okay, now when we talk about short-term investments, we talk about investing in debt or equity securities. So a company might buy stock in another company or might buy another company's bonds. And there's 2 reasons companies would invest in another company, at least 2 reasons. First of all, they might have excess cash. What do we do with our excess cash? Well, we invest it to earn some money in the meantime, hopefully. Or we might want to buy for strategic reasons. Like, for example, we might want to buy a key supplier. Or we might buy a competitor. For example, Comcast wanting to buy Time Warner. That's an investment they're making. And they've got strategic reasons for doing so. Now, when we have investments, we can have long-term investments and short-term investments. Short-term investments are under a year, and the company intends to convert them to cash within a year. That's a short-term investment. Otherwise, it's a long-term investment. In this chapter, we're talking about short-term investments where a company has an intent to hold it less than a year. Now, there are 3 types of investments. There we go. There are 3 types of investments. We can classify investments in 3 types. First of all, trading securities. These are the ones that we buy. We have the intent to sell them pretty quickly. So we'll buy them. We have maybe spare cash sitting around for 10 days, 20 days, or whatever. But we buy these securities to trade them. We have available for sale, which it's a longer term intention. And then we have held to maturity. The ones that we're doing in this chapter are trading securities. So trading securities are debt, which is bonds or notes, or stock in another company. They're expected to be sold in the near term. We have active trading involved, and they generate income and losses on a day-to-day basis by their price changing. So you're looking at the Wall Street Journal, you see fluctuating stock prices. That's what's causing these day-to-day income or losses on these trading securities. Chapters available for sale and held to maturity, those are in Chapter 8, so we're not going to do this. In this chapter, we are dealing simply with trading securities. These ones that we hold that we're planning to sell very quickly. We're generating gains and losses on a day-to-day basis because the price of them is changing. Okay, so trading securities. What I've got in terms of trading securities today, we have 5 or 6 journal entries that I would definitely put on my reference sheet. because you don't have to reason them out every time you do them. So we're going to go through those journal entries. There's also very specific vocabulary that relates to trading securities. So when we pick up a income statement and we see this vocabulary, you immediately know what it means. Okay, so let's go through an example. We'll be using this example that assume on June 18, 2014, Apple purchases 5,000 shares of Intel stock as a trading security. So they purchased 5,000 shares of stock, trading security, meaning they're not holding it long term, they intend to sell it. Now suppose that this is Apple's only short-term investment. The only reason that statement's there is so we don't need to worry about anything else muddying up our explanation here. Apple buys the Intel stock during 2014 for $20 per share, paying $100,000 cash. Okay, so basically Intel bought this Apple stock, or Apple bought the Intel stock for $100,000. Okay, that's the facts here. So when we buy an investment with cash, we're going to be increasing the investment in trading securities, which is an asset, and decreasing cash for $100,000. So this is transaction stuff like we did in Chapter 2. So that's when we make the initial purchase. Okay, so we have this initial purchase of our investment. We're debiting the investment for the amount. So what's important here, we're debiting $100,000 to the investment account and crediting cash for the $100,000. So that's one journal entry for when we make the purchase. Now, as Apple holds its Intel stock, it can also pay dividends. If we have dividends paid while we hold it, let's say we assume we receive a cash dividend of $4,000. So if we receive a cash dividend of $4,000, we're going to be debiting cash to the $4,000 and crediting dividend revenue for $4,000. So that's it. So that's another transaction that can occur with a short-term investment. Okay, so that's journal entry 2. We have the first one we did, which was to purchase the investment, the second one to record the revenue we received, and now we get to the specific vocabulary having to do with these trading securities. Trading securities are always reported on the balance sheet at the current market value. Market value, fair value mean the same thing, and if the fair value has increased, so if the market value is higher than when we originally got it, we are going to have an unrealized gain. If it's lower, we're going to have an unrealized loss. That word unrealized is the word that has a very specific meaning. I'm going to pause for a minute, let you catch up writing wise, and then we'll talk about that. The term unrealized has a very specific meaning. Unrealized means we haven't sold the stock yet, that this is a gain or loss based on the market value. So we go to the Wall Street Journal and we look up the market price of the Intel stock. And if the market price is higher than what we bought it at, then we have an unrealized gain. If it's lower, then we have an unrealized loss. With trading securities, we are adjusting to the fair market value. So we have this unrealized gain and unrealized loss. When you see the word unrealized, that specifically means we have not sold this stock. That is, this is the market value. So our investors know that we're still holding this stock, that we haven't actually had a transaction with an outside party, and we're basing this on market value. Okay, so let's go through an example. And if you're just joining us, we have not closed the first Learning Catalytics question yet. Haley keeps posting the Learning Catalytics session ID in the window. We're going to be closing that probably in a couple of minutes. So make sure you're getting logged in, but you haven't missed a question yet if you're just joining us. Okay, so unrealized gains and losses. So let's say that their year ends September 27th. The fair market value of that Intel stock's now $110,000. They bought it for $100,000. Now it's $110,000. So if we bought it at $100 and it's $110 now, that's a gain. And it's unrealized because they still are holding it. They still have that Intel stock. So what we're going to do here is we're going to have investment in trading securities. That $10,000 is the amount that the market value has increased. That our investment went from $100,000 to $110,000. And then the credit will be to unrealized gain on trading securities. So first of all, I would write these journals down. You want to make sure if you have a gain that it looks like this. The reason, you don't need to reason through it every time you do it, but we are increasing the investment account, which is an asset. So we have to debit the investment account to increase it. The unrealized gain is a credit because it's a form of revenue. To increase revenue, we credit it. It's actually other income, it's not, but it works like revenue. So we have this debit to investment and debit to trading securities of investment in trading securities and credit to unrealized gain for the amounts. And if we look at what's happening in our T accounts, we have $110,000 now in the investment, in the asset, and we have $10,000 listed as an unrealized gain. That's considered other income, and we're not going to get into other incomes, a topic you get if you're an accounting major. You'll learn a lot more about other income as you go forward. So this was the journal entry if you have an unrealized gain. And again, if you still hold it, the problem might not say unrealized to you, but it says they still hold it and the current market value is, that's unrealized. We haven't sold it yet. Now the other circumstance that can happen is we can have a loss. So we're going to go through an example of a loss. So let's say right now our investment at the end of 2014 fiscal year is $110,000. So let's fast forward now a year ahead to 2015. And now this investment is worth $105,000. So it's on our books at $110,000. That's referred to as its carrying value. What's it on our books for? It's on our books for $110,000. Now it's worth $105,000. So this we have a loss, and it's an unrealized loss because we still have the investment. We have a trading security that we could trade at any time. We have the intent to trade it. We just haven't yet. So what we're going to see here is we're going to debit the unrealized loss. Losses work like expenses. And we're going to credit investment in trading securities so that we can reduce the investment. to. Okay. When we started this problem, when we ended last year, we had a carrying value of 110,000. I'm going to go backwards for a minute. Okay, so down in the bottom, the T account, we have a balance of this investment of 110,000. That's as of the end of 2014 fiscal year. So now with this problem, it's saying this is the end of 2015 fiscal year, and now this has a balance of 105,000. So the 105,000 compared to the 110, the differences are 5,000 lost. It went from being worth 110,000 down to 105,000, so that 5,000 is the amount of the unrealized loss. That was the original 110 less the current value of 105. So that's where the 5,000 came from. Yes, you would put dates on them if it requires it in my accounting lab. Not all the time does it. I just left it off so we wouldn't have more writing. Okay. Okay, so the important takeaway, if you see the word unrealized, that automatically triggers that we have not sold it. We still own the underlying stock, or underlying the investment. Okay. Now, we also have realized gains and losses. We're using the word realized here. It occurs only when the investor sells an investment. Typically, you will not see the word realized. We're using it here to highlight it, but if you see just gain or just loss, that means that they have sold the investment. Unrealized has to be used. The word unrealized has to be used if they still own it. But if they sold it, they can just have a gain or loss. So if the sales price is greater than the carrying amount, we have a realized gain, typically just referred to as gain. And if the sales price is less than the carrying amount, we have a realized loss, which again is typically just referred to as a loss. Okay, let's go through a quick example of a realized gain. Let's say our Intel stock, we left off the example, it was worth 105. So now let's say we take this Intel stock that we now have on our books at 105,000 and we sell it for 107. So we have this Intel stock. We ended the last example, it was 105 on our books. We sell it for 107. So what we're going to do here is we're going to get 107,000 cash. So we're increasing cash. And then we want to take out our investment in trading securities. We're going to credit it for 105. That was what it was worth at the end of the last fiscal period. So the last example we did, it was worth 105. That's referred to as its carrying value, what was most recently on our statements. And we know our debits have to equal our credits, so we have a $2,000 difference here, and our only decision here is that a gain or a loss. We were carrying it on our books at 105. We sold it for 107, so that's going to be a gain on sale of trading securities. Okay, and it's a gain because we sold it for more than its carrying value. Okay, now what we're going to do now is we are going to go into learning catalytics, and we're going to answer the first question, and then we have a couple questions after that. So we're going to leave this, go into Learning Catalytics. Okay, now, the first question has been up there since we started class. The party to whom money is owed is the debtor, the creditor, the payer, or the lessee. Okay, so make your selection. The session ID is at the top of the screen, the 709984879. And again, we're doing based on participation. So you have about 5 seconds left to answer this one, and we're going to go on to some related to unrealized and realized gains. Okay, 5-second warning. Sorry, cut it down. Okay, the party to whom money is owed is the creditor, okay? And we're going to see that when we come up on notes receivable, but creditor is the party to whom money is owed. Okay, now we're going to do a couple questions. Okay. And again, you might need to refresh your screen. Short-term investments may be divided into held-to-maturity securities, trading securities, and available-for-sale securities. True or false? Okay, short-term investments may be divided into held-to-maturity securities, trading securities, and available-for-sale securities. Make your answer selection. Okay, 5 seconds. Okay, and that is true. Those are the 3 categories. The trading securities are what we're dealing with in this chapter. The other 2 are going to be in Chapter 8. So we're going to do another couple. An unrealized gain occurs when a company sells a trading security. True or false? You're writing these down, right? I didn't give you a last one. Okay, 5 seconds. Okay, and that was false. The word unrealized means the company has not sold it. Unrealized means the investment has not yet been sold, and this is market value, so that has to be false. And then we have one more. The company will have an unrealized loss if the fair value of the investment is greater than its cost. True or false? I do. But I was just saying. Okay, 5 seconds. Company will have an unrealized loss if the fair value of the investment is greater than its cost. Notice I've given you a hint at the bottom. Unrealized loss occurs if fair value is less than cost. Emphasis on the word less. So 5-second warning. Okay, this one is false, and I gave you the hint at the bottom. It's false because a loss occurs if the fair value is less than its cost. This question refers to greater, and greater would mean that it's a gain. Okay, we're going to go back to the material then. Okay, and now we're going to touch a little bit on revenue recognition. We did this in an earlier chapter. We're talking about when to recognize revenue, but here we have some specific terminology. You do not need to memorize these 3 criteria. We typically have very specific criteria when we recognize revenue. The goods or services have to be provided to the customer. So we have to have performed the service or delivered the goods. We have to have done that. The price is fixed. We know what we sold it for, and we're reasonably assured that we're going to collect. So those 3 criteria need to be met. Absolutely, I would not memorize those 3 criteria. The revenue is the cash value of the goods or services. This is impacted by shipping terms and payment incentives, which is what we're going to do now. We're going to look at shipping terms, how they impact revenue recognition, and payment incentives. Okay, so basically looking at shipping, revenue recognition, shipping terms, and payment incentives. Okay, so to illustrate this, we're going to have an example. And the example is, assume Apple delivers a truckload of iPhones to an AT&T warehouse in Florida. On the truck are 30,000 iPhones, which Apple sells to AT&T for $100 on account. Okay, so Apple sells these things on account. When we make this journal entry to sell something on account, we're going to debit accounts receivable and credit sales revenue, and that's going to be to sell on account. The calculation is 30,000 phones times $100 each. That gives us our $3 million. We don't have a date here because there's no date given. But that's when we make a sale on account. We're going to be debiting accounts receivable, crediting sales revenue. I've got the link for Academic Success Center on Blackboard. Okay, now when we talk about revenue recognition, this seems pretty straightforward. They sold the phones. They're going to recognize sales revenue for the $3 million. But the question is, does Apple recognize the revenue on the day they ship the phones or on the day that AT&T receives them? And I'll give you a hint. Both parties recognize on the same day. So we don't just pick and choose based on who we are. If we let companies just choose when they recognized it, it would be chaos and we would not have any faith in the financial statements. So there's very specific rules. And those rules are basically when title transfers is when we recognize the revenue. We're not given enough information in this example yet to be able to know what date that occurs, because we're not told when title transfers. And this brings us to our next point about shipping terms. Shipping terms dictate when title transfers. So we have two shipping terms to know. One is FOB shipping point and the other is FOB destination. Free on board is what FOB stands for, but you always see FOB shipping point, FOB destination. Those are our two choices. FOB shipping point first. FOB shipping point means that title transfers at the shipping point, at the seller's shipping dock is when the title transfers. So the goods leave the shipper's selling dock. As soon as those goods leave, the buyer owns them and the sale is recognized and the buyer recognizes the purchase. So when title transfers is when both parties recognize the sale and the purchase. So FOB shipping point means it occurs at that point. FOB destination then is FOB destination says title transfers when the goods arrive. So until the goods arrive, Apple owns those phones. Until they actually get to AT&T's warehouse, Apple owns them. So shipping terms can be either one. Shipping terms can be either FOB shipping point or FOB destination. You do not recognize revenue until title transfers, until they've been, until either the shipping point or the destination, depending on our situation. Okay, so those are shipping terms that deal with revenue recognition, when revenue is recognized. We also have payment incentives that determine, have an impact on revenue. We have sales discounts. Which one is more commonly used? There's not really an answer for that. Your question, like in this class, will tell you if it's FOB destination or FOB shipping point. If it's silent, you can just assume it happened. So maybe there won't be, unless it's specifically asking about it. Sometimes there's questions without dates and you can just go forward with those. But in this specific one, it'll tell you if it's FOB destination or FOB shipping point, and there's not a more common one. There's not a default one. Okay. Now, sales discounts, more specific terminology. So we have a lot of terminology in this class. Sales discount does not refer to 20% off sale. Sales discount is an incentive offered for early payment. So we are offering a discount if our buyer pays us sooner than the terms call for. So a typical incentive, this is in the box, you see 210 net 30, 2/10 comma n/30. That is pronounced 210 net 30. Okay, what this means, and this is just an illustration, but what this means, that 210 means there's a 2% discount if paid within 10 days. Okay, so the first number before the slash is a percent discount. So if that said 110, that would be a 1% discount if paid within the number of days. And then the N30 means that the full invoice amount is due in 30 days if not paid within the discount period. So when we talk about a sales discount, we are talking about an early payment incentive. Sales discount is actually an account, and it's an account. It's considered to be a contra sales account or contra revenue account in that it reduces sales. So we don't put these early payment discounts in sales. We put them in their own account, sales discount, and we'll see on this one. Okay, so let's go through a sales discount example, and then we'll talk about the account type again. Sales discounts are discounts offered for early payment. A typical incentive, 210 net 30. That could be 110 net 45. A 1% discount is paid within 10 days, the whole amount due in 45. If Apple offered AT&T terms of 210 net 30 and AT&T pays the invoice within 10 days, it's entitled to a $60,000 discount. $60,000 discount is taken by taking 2% of the $3 million. So 2% times $3 million is $60,000. Okay, so the journal entry when we're making a payment early or receiving a payment from a customer is first of all figure out the cash. If AT&T takes the discount, they're going to take a $60,000 discount. $60,000 is going to be your $3 million times 2%. So we don't get, AT&T doesn't have to pay that $60,000. So the original invoice was $3 million. Subtract the $60,000. That's where we got the $2,940,000. So we have cash. We have a sales discount of $60,000. I'm going to put it all up there. I'll let you write it down, and then I'll talk about the numbers again. This is definitely a journal entry I would have in my repertoire. So I'm going to start at the bottom, accounts receivable. We're crediting accounts receivable, and when I'm saying we're Apple here. We're the seller. Now, AT&T pays their invoice within 10 days, so AT&T doesn't owe Apple anything now. So we need to wipe out the original accounts receivable. So we're going to credit accounts receivable. Accounts receivable is an asset. We'll credit it to get rid of it, so we have a credit for $3 million. Then the cash that Apple receives from AT&T if they pay within its discount period is less the original invoice amount less the 2%. So we had the original invoice amount of $3 million minus the 2%, which is the $60,000. That's where we got the $2,940,000. And then we have a debit to sales discount of $60,000. Sales discount is a contra sales account or contra revenue account. It reduces our sales. So when we show our sales on our income statements, we're going to have sales. They'll have less discounts, and but we keep it separate because it could be important to an investor to see how much early payment incentives we're giving. And this next one coming up, we also have one more sales contra sales account coming up. But this is the sales discount. So sales discount, very specific term, relates to early payment incentives. So on our next one then is we also have sales returns and allowances. Sales returns and allowances are when the customer returns unsatisfactory merchandise to us. So let's assume that now for this example we're just assuming they still, AT&T has not paid anything yet. AT&T has not paid anything yet, so they still owe the original $3 million, and it says of the 30,000 phones, 100 are returned because they're damaged. So when we have sales returns, what we're going to be doing is we're going to debit sales returns and allowances. Sales returns and allowances is a contra sales account. It reduces sales, and will credit accounts receivable. Accounts receivable is the asset. When AT&T returns those 100 phones, the 100 phones times the $100 invoice price is the $10,000. Then we have to reduce what AT&T owes Apple. Again, this example assumes that AT&T has not paid within the discount period, so this is independent of the prior one. So sales returns and allowance is a contra sales account. The reason we want to keep this one separate is as an investor, I'm looking at a company's sales. It's really important to me to see how much returns and allowances they have. Are they typically selling subpar goods and they're being returned a lot? That we would want to track that over time and watch that as an investor. So that's why that's separate. Okay, we're going to do a couple questions now. Okay, the first one. When goods are shipped FOB destination, revenue is recognized by the seller when the goods leave its shipping dock. True or false? When goods are shipped FOB destination, revenue is recognized by the seller when the goods leave its shipping dock. Okay, 5 seconds to get your answer in there. Okay, this is false because when goods are shipped FOB destination, title transfers when they reach the destination. So revenue is recognized by the seller when the goods arrive at the destination. One more. ABC Company has shipped goods to one of its customers' FOB shipping point. ABC Company will recognize sales revenue when what happens? When the customer has received and inspected the goods, when the goods leave ABC shipping dock, whenever the two parties agree, and when the customer pays the invoice. Okay, so think about when title transfers, FOB shipping point. ABC has shipped goods to one of its customers' FOB shipping point. When will ABC recognize the sales revenue? Okay, 5 seconds. Go ahead. Okay, ABC Company has shipped goods to one of its customers' FOB shipping point, so that means title transfers at the shipping dock. So the title will recognize sales revenue. The entry is B. The answer is B, when the goods leave the shipping dock. So title transfers, FOB shipping point. Title transfers right then, and that's when revenue is recognized. FOB destination means it will be recognized when it reaches its destination. Okay, so what we're going to do now is we're going to do short exercise 5-5, and this is to get our set of facts. We first have 5-4. In my county lab, it's all one continuous one. But 5-5, it's asking about 5-4. So in 5-4, it says that a manufacturing company sells a truckload of sporting goods to Sports R Us. Terms of the sale are FOB destination. Okay, FOB destination. That tells us that the title transfers and revenue occurs when the goods reach their destination. The truck runs into bad weather on the way to Amarillo and doesn't arrive till January 2nd, 2015, and the invoice totals $308,000. What should the company report in its 2014 income statement? Well, it doesn't record the sale at all because the goods are shipped FOB destination and they don't arrive till January 2nd. So they're not going to record in 2014 at all. So then we go on to the actual exercise I wanted to get to. 5-5 is refer to the facts in 5-4. The sales term on the invoice are 210 net 30. So what does that mean? Well, 210 net 30 means that they'll get a 2% discount if they pay the invoice within 10 days. Otherwise, they have to pay the full amount within 30 days. So 210 net 30 means that Sports R Us will get a 2% discount if it pays the invoice within 10 days. Otherwise, the full amount is due within 30 days. So 210 net 30 So be able to interpret that. So I might ask you, what does 115 N45 mean? Well, that means a 1% discount is paid within 15 days. Otherwise, the full amount is paid within 45. So just 210 net 30 is a nice one to remember because it is so common. Okay, next question. What is SportsRS's potential savings, if any, from this discount that's being offered? Well, their savings are going to be $6,160. That's the $308,000 invoice times 2% less the 2% from the 308. We can also take $308,000 times 98%. Because if you have a 2% discount, then you have 98% you're paying. And then the last question, how much time does the company have to take advantage of these savings? The company has 10 days. Okay, so 10 days to take advantage of the savings. Okay, 10 days. Okay, then as we get on to the other, there's two big topics in the chapter. One's accounts receivable and the other is notes receivable. And we're going to do part of accounts receivable today. Yeah, by 0.02. Okay, now accounts receivable. Accounts receivable are typically the third most liquid asset. It's basically accounts receivables in general arise from sales of goods and services to others, which is accounts receivable, or lending money, which is notes receivable. Okay, so accounts receivable, another name for accounts receivable is trade receivables. Okay. Accounts receivable is where we sell our goods or services and our customers say, we'll pay you later. When we make a sale on account, we've done these journal entries before. When we make a sale on account, we're going to have accounts receivable, our asset being debited, and crediting service revenue. Okay, so that hasn't changed. We have a new term coming up here, more vocabulary. Okay, and the vocabulary that I want to point out is this phrase called subsidiary ledger. Okay. Now, accounts receivable is the account that we do all the transactions in. So a customer buys from us on account, we put it in accounts receivable. A customer pays us on account, we take it out of accounts receivable. So we have all these customer account transactions going on in accounts receivable. But if we didn't do anything else, we would have no way at any given time of knowing who owes us what and making collections. So what we have is we have something called a subsidiary ledger. And a subsidiary ledger is a record, individual records of every customer. So let's say we have 3 customers. So our business has 3 whole customers, Brown, FedEx, and Moody's. Those are the 3 customers we have. So we have a subsidiary ledger that has an account for every single customer. So we have an account for Brown, balance 5,000. We have FedEx, balance 1,000, and Moody's, balance 3,000. So every time a transaction happens that to a customer, it's put into their account. So at the end of the period, I can add up all my subsidiary accounts, the Brown account, FedEx account, and Moody's, add those up, and those equal my accounts receivable account. Sometimes accounts receivable is referred to as a control account because it's the big one, and then all the subsidiary accounts add up to be that total of the control account. So that's just some vocabulary for us. Now, when we sell on account, we sell to people and they promise to pay us within the period. Sometimes that doesn't happen, and those are called uncollectible accounts or bad debts. And what we're going to do probably for the rest of today, well, I know for the rest of today and some of Wednesday as well, is we're going to go on uncollectability. Okay, so uncollectability, these are the deadbeats. Okay, we sell on credit. We sell on credit to make it easier for our customers to buy from us. They did an estimate, they did a study one time recently, and they looked at how they compared businesses that accepted credit cards to businesses that didn't accept credit cards, and the sales were phenomenally higher if businesses accepted credit cards. It's the same thing when a business goes to extend credit to its business clients. If it extends credit, it has a lot more sales opportunities than if it operates cash only. So benefits of selling on credit, sales and profits will increase. Okay, extending credit helps increase your sales. Now there's a cost of doing that. The cost of selling on credit is that company can't collect. Some customers are not going to be able to pay. It's going to be uncollectible account expense. When you extend credit to someone, you're looking at their credit score if they're an individual. You're looking at their credit rating if they're a company. And you're only extending credit to people you feel who are you're reasonably sure they'll pay. Things happen and sometimes you don't get paid. So you have to have some way to balance it. So you say, okay, well I'm going to tighten credit so that I can minimize the amount of people that don't pay, but you're going to have some people not pay you. It is just a cost of doing business. Okay, now when you make a sale, you go through the month, you make all these sales, you know that some of those people are not going to pay you. You don't know which ones, because if you knew which ones, you wouldn't sell to them. So what you do is each month you say, okay, I have a certain amount of sales this month. I know some of those people aren't going to pay me. I want to recognize some uncollectible account expense, but I don't know which ones are bad, so I have to have some way to estimate that. So what we'll do, there's two different methods to estimate what percentage of people won't pay you. But I'm getting ahead of myself. We have an allowance method, and the allowance method says since we don't know who's not going to pay us, we're going to set up an estimate of uncollectible accounts because we don't want to overstate our assets. If we don't recognize any uncollectible accounts and we just say, here's what everyone owes us, we know some people aren't going to pay us. What we're doing is we're overstating our assets. So we want some way to say, here's what we're owed, and then here's what we think we're not going to get paid, and then the difference is what that asset is really worth. So this is called the allowance method, and it's based on our company's collection experience. What percentage do you typically collect? You know, companies have a very good feel for what percentage of customers will pay them ultimately. So what they do is they set up an allowance for uncollectible accounts. Notice that this is just, we've had some other contra accounts today. This is a contra account to accounts receivable, meaning that it's always shown with accounts receivable. So we have accounts receivable, which is what everyone owes us, And then we have allowance account, which is how much we think we're not going to get paid. So if we take the accounts receivable, subtract the allowance, that's going to be what we think we're going to get from this asset. Now, this allowance account, this is a contra asset, meaning it reduces the asset. There's two ways that we would see this on our balance sheet. So the first way, and again, these aren't to memorize, but just so you know that either way is correct for companies to use. We have on our balance sheet, we'll see accounts receivable less the allowance, and then that'll give us, we'll take the 500 minus the 25, and off to the side you'll see 475. So the 475 is the 500 minus the 25. So that's one method. So all we're doing there is we're showing the accounts receivable, we're showing the allowance, and then we're showing the net. That's one way. Companies more commonly do the other way, which is just to list it on one line. So just list the 475 and then list the allowance of 25. And then you would know their gross receivables just by taking the 475 plus the 25. It says, oh, they're owed 500, but they think they're not going to collect 25. Okay. Now, this allowance account is our estimate of what we're not going to collect. There are two ways to estimate. The first one is the percentage of sales method. And you need to know both methods. We're going to do both of them on Wednesday. But the percent of sales method is called the income statement approach. And the aging of receivables method is known as the balance sheet approach. The percent of sales method is the easier of the two methods. Percent of sales is just what it sounds like. We estimate that a certain percentage of our sales every period turn out to be uncollectible. So we simply say, let's take our uncollectible percent, whatever percent that is, times our sales revenue for the period, and that's going to give me the uncollectible account expense. That's it. Okay? So the percent of sales method is called an income statement approach because it focuses on the income statement. It says, here's sales revenue, let's multiply by our percentage, and we'll get our uncollectible account expense. So it's pretty easy. That's all we have to do for that one. The other one that we have listed back here, the aging of receivables method, what we do is we go through and add up all our accounts that are overdue by a certain period of time and take a percentage of those. And that's referred to as a balance sheet approach because we're looking at what's actually owed to us and estimating based on that. But the percent of sales method is the first one we're going to do, and that's taking a percent of the sales revenue for the period, and it's just pretty straightforward like that. And that's all the further we're going to go today because on Wednesday we'll start with these two methods.